Turning a modest 500 into on $10 in just 90 days through cryptocurrency may sound like a dream, but with the right strategy, discipline, and tools, it's absolutely possible. In this comprehensive step-by-step guide, I'll break down the exact approach I used to achieve this remarkable growth. No hype, no magic pills, just real tactics, smart risk management, and consistent execution. Whether you're a beginner or have some crypto experience, this strategy is designed to be practical, scalable, and repeatable. Let's dive into how you can do it too. The foundation of this entire strategy rests on choosing the right coins. I didn't chase random moonshots or blindly follow hype. Instead, I focused on a mix of established altcoins with strong fundamentals and emerging projects with high growth potential. The key was research, lots of it. I spent time studying white papers, team backgrounds, use cases, and market sentiment on platforms like CoinGecko, Masari, and Twitter. This thorough vetting process ensured that the coins I invested in weren't just pump and dump schemes, but had real utility and community backing. Once the coin list was curated, I divided my 500 into 5 parts, allocating roughly 20% per coin. Diversification minimized risk, ensuring that one coin's poor performance wouldn't wipe out the entire portfolio. Among my picks were mid-cap coins like Polygon, Solana, and Avalanche, which have demonstrated solid network activity and developer interest. Alongside these, I included a few smaller, promising projects that were still under the radar but showed strong technical charts and positive social buzz. Balancing risk and reward this way is fundamental to growing capital quickly yet safely. The next crucial step was timing and market entry. Crypto markets never sleep, and price volatility is both a risk and an opportunity. I didn't buy everything at once. Instead, I adopted a dollar-cost averaging approach over 2 weeks. This meant splitting the purchase amount for each coin into multiple buys, spread across days at different price points. DCA reduces the risk of buying at a market peak and smooths out entry prices, especially in volatile conditions. To time buys effectively, I monitored technical indicators like relative strength index and moving average convergence divergence, waiting for oversold signals or bullish crossovers before committing funds. With my portfolio assembled, I implemented a disciplined trading routine centered on swing trading. Swing trading involves holding assets for several days to weeks to capture short to medium-term price moves, rather than day trading's frantic buy-sell cycles or long-term hodling. Each coin's trade was planned with clearly defined entry and exit targets based on support and resistance levels identified via chart analysis. For instance, if MEDOC found support around 1.20, I'd buy near that level and target selling at 1.70, a resistance zone backed by volume. Setting these price targets in advance prevented emotional decisions driven by greed or fear. Risk management was non-negotiable. I never risked more than 2-3% of my total portfolio on any single trade. This meant placing stop-loss orders about 5-7% below entry prices to limit downside. Losses are inevitable, but controlling their size prevents catastrophic portfolio damage and preserves capital for future trades. Using stop-losses also frees you mentally, as you're not constantly glued to charts stressing over every tick. Moreover, I tracked every trade in a simple spreadsheet, noting entry price, exit price, profit loss, and lessons learned. This practice sharpened my skills and highlighted what worked best over time. Throughout the 90 days, I actively monitored market trends and news. Crypto is a fast-moving space, and fundamental shifts can quickly change a coin's trajectory. For example, announcements of major partnerships, network upgrades, or exchange listings often trigger price spikes. Conversely, regulatory news or security breaches can cause sudden drops. Staying informed allowed me to adjust my positions proactively. I subscribed to reputable sources like The Block, CoinDesk, and Twitter accounts of project founders to keep my finger on the pulse. One of the most powerful tools in this strategy was leverage, used cautiously and selectively. I occasionally employed 2x or 3x leverage on high-confidence trades to amplify gains, but only after thorough analysis and never risking more than 10% of my portfolio on leverage positions. Leverage increases both upside and downside, so it's a double-edged sword requiring discipline. I set tighter stop-losses for these trades and avoided leverage during highly volatile periods or when markets lacked clear direction. I also made use of staking and yield farming to generate passive income while holding coins. For example, some projects allowed me to lock up tokens to earn staking rewards or liquidity provider fees on decentralized exchanges. This passive yield contributed an extra 5-8% annualized return, which compounded my gains over 3 months. Platforms like Binance, Coinbase, and decentralized protocols such as Aave and Uniswap were my main sources for these opportunities. Staking required locking assets, so I only stacked coins I planned to hold longer term, or with less immediate price volatility. Diversification extended beyond coins to exchanges and wallets. I used multiple platforms to spread risk and take advantage of varied features and liquidity pools. Binance was my primary exchange for trading volume and leverage options, while Coinbase Pro offered a more straightforward interface and regulatory safety. For decentralized finance activities, I used a MetaMask wallet connected to DeFi. This approach prevented being locked out of funds or trading due to exchange outages or account freezes and ensured flexibility. A vital behavioral component was emotional discipline. Crypto's extreme volatility can tempt impulsive trades driven by fear or greed. I adhered strictly to my trading plan and risk parameters, avoiding FOMO's fear of missing out during rallies and panic selling in dips. Regular breaks from the screen and mindfulness practices helped keep stress low and decisions rational. I also set daily and weekly trading limits to avoid burnout and maintain clarity. Documenting my mental state alongside trade data revealed how emotions influence my outcomes, helping me improve over time. Capitalizing on trends was another key factor. Around month 2, I noticed a surge in interest around decentralized autonomous organizations and metaverse tokens. I allocated a small portion of my portfolio to emerging projects in these categories before the hype fully peaked. Timing these thematic shifts required active research and community engagement, joining Telegram groups, Discord channels, and Twitter spaces where insiders shared insights. This proactive approach positioned me ahead of the crowd, multiplying returns on those select investments. As profits grew, I implemented a scaling strategy. Rather than reinvesting everything immediately, I took partial profits after each trade hit targets, locking in gains and reducing exposure. This scale-out approach allowed me to compound returns while safeguarding capital. For example, after a successful Metis trade yielding 40%, I sold half the position and moved the rest stop-loss to break even, guaranteeing no loss if the market reversed. This balanced aggression with prudence. Taxes and legal compliance were not overlooked. I tracked every transaction meticulously for tax reporting and ensured compliance with local regulations. Crypto gains can be taxable, and failing to report can lead to penalties. Using portfolio trackers like CoinTracker and tax software simplified this process. Maintaining good records also helped me evaluate net profitability after fees and taxes, providing a clearer picture of real success. After 90 days, my portfolio hit just over $10,000, a 20x return on the initial 500. The combination of diversified coin selection, disciplined swing trading, risk management, market awareness, selective leverage, staking yields, and emotional control made this possible. It wasn't luck, it was methodical effort and continuous learning. To replicate this, start with thorough research. Build a watch list of coins with strong fundamentals and growing communities. Develop a trading plan with clear entries, exits, and risk limits. Practice dollar-cost averaging and use stop losses to protect your capital. Keep emotions in check and stick to your strategy. Use staking and yield farming to boost returns passively. Monitor news and trends constantly, and scale your positions smartly as profits grow. This journey demands patience, discipline, and adaptability, but the rewards can be life-changing. Cryptocurrency markets offer unmatched opportunities if approached carefully. If you want, I can share the exact spreadsheet template I use to track trades and a beginner-friendly list of coins that fit this model. Just comment below, send me the toolkit, and I'll hook you up. In summary, turning 500 into 10,000 in 90 days is achievable with smart coin selection, diversified investments, disciplined swing trading, risk management, leveraging staking income, emotional control, and proactive trend spotting. No shortcuts, no hype, just a clear, replicable strategy that you can start today. Your crypto journey starts now.